Hey guys, so in our last video we created a value screen where we ranked the investing universe using price multiples from least valuable to most valuable, or least undervalued to most overvalued. And these price multiples were PE, price to sales, price to book. And in that screen we looked at the output and we realized, what if we could create or overlay a quality screen on top of that? And quality meaning that did it have a strong balance sheet, a strong income statement, cash flow statement on top of that. And so in this video, we're going to create a simple quality screen, a preliminary quality screen, and investigate the different variables and hopefully overlay that onto our original value screen. So let's get started. So I'm pulling our data from FinViz, again, just like last time, and I'm exporting the data into a CSV file. So if you go to this website, you can export data here. And I've already done that. I'm using pandas to import that data. So I'm going to use a pandas read CSV function where I'm going to read the CSV and put it into a pandas data frame called df. So let's run that. Let's take a look at the columns. These are the data points that we're interested in. And in this video, we're going to look specifically at return on equity. And return on equity is a pretty valuable metric that a lot of CFOs, financial executives use in managing their company. And it's really a basis or a measurement of, it's a popular yardstick of financial performance. And it's composed of three different variables, and that is profit margin, asset turnover, and financial leverage. We're going to focus more on the profit margin and financial turnover aspect of return on equity, and that's just because we have preliminary data here. Maybe in future videos, I'm going to try to expand that out more in our ranking, but this should just get you started in building a quality ranker and providing economic intuition into an economic theory into it. So let's talk about return on equity. So return on equity is, like I said, it's a popular yardstick in measuring financial performance. And what is it? You're taking your net income divided by shareholders' equity. And it's really showing bang for buck. It's showing the investment return that is derived from equity. And if you take return on equity, it's comprised of three ratios, like I said. That is profit margin, asset turnover, and financial leverage. So if you multiply those three ratios, that will equate to the return on equity. So what is profit margin? That is just net income divided by sales. And if you multiply that by net asset turnover, that is just your net sales divided by assets. And then again, multiply that ratio by the financial leverage, and that is just your assets divided by shareholders' equity. That's just a ratio that shows the financial leverage of the company. So if you multiply those three ratios together, you should get return on equity. So we're going to use each of those components in deriving return on equity. So let's take a look at some of the data in here. So you'll notice that they give us return on equity, which is right here. We can break that apart into profit margin, and you'll notice we don't have asset turnover here, but we do have return on assets. And what you'll find is return on assets is equivalent to taking your profit margin multiplied by your asset turnover. So if you took your profit margin multiplied by your asset turnover, that would equal your return on assets. So we do have asset turnover in this component right here. So we can rank this. So we're going to take a return on equity. We're going to take a return on assets. Another variable that we're going to take a look at is the components of profit margin itself. So what is composed of profit margin? So if you can think about it, it's your gross margin. It's also your tax rate. All of that goes into the bottom line of profit margin. We actually have gross margin. We also have operating margin. Again, operating margin sits below the gross margin. Remember, what is gross margin? That's just taking your gross profit divided by your total revenues. Basically what you're doing is you're taking your revenues, you're subtracting any cost to deriving those revenues. That's called cost of goods sold. Then you get your gross profit. And then from gross profit, you can subtract out other operating expenses. That's such as your sales or your marketing, etc. And then finally, once you subtract all that out, you'll get something called your operating profit. And so that is how you get operating margin. So if you take your operating profit divided by your sales, you'll get operating margin. So those are all derived. And if you keep continuing moving down from operating profit, you move interest and tax, you'll get to profit in that income, earnings, etc. And that is, we can derive our profit margin by taking that net income divided by our sales. So we have all these great variables. We even have some other variables like leverage variables here like debt to equity, total debt to equity, etc., and some other ratios here. So let's get started and start ranking some of these variables. Again, we're trying to provide economic intuition into this, or economic theory into this, without just ranking any type of variable, to get an idea of what is quote unquote a good quality company versus a bad quality company. And when you read into the academic literature, you'll find that it's debatable. The quality factor is a debatable factor, and different companies, different experts have ranked stocks on different quality metrics. So feel free to push back, critique, or have any ideas on how to improve this quality ranking score that we're going to try to create. So I'm just going through our normal process here of cleaning up this data. I'm removing this sector conglomerates because it's not exactly useful, and we want to look at specific securities. We're removing exchange traded funds, ETFs, any closed-end funds, debt, and equity. Now let's begin looking at our first metric. So we're going to look at return on equity here. Here we go. So all I've taken is, you'll notice actually in this data set before I begin, return on equity is a string variable. Basically, it's not an integer. It's not in decimal form. So what we need to do is we need to apply a lambda function. That's all I'm doing here. I'm taking this return on equity column in our data frame, and I'm cleaning it up. For every value of x, all this lambda function is saying is for every value of x. And if you're getting confused, if you're getting intimidated about a lambda function, it's just a function. That's all. It's a customizable function that we can put into our data frame. And so what I'm doing is for every value of x, I'm taking x, I'm converting it to a string. It already is a string, but I'm making sure it's a string. And then I'm stripping off the percentage sign, because if you look at the data, you'll find that it's a string with a percentage sign in it, and I want to remove that. Then I'm converting it into a float. A float in Python is it's a variable that where we can actually calculate and do math on top of. And then I'm dividing it by 100 to turn it into a decimal. And then I get return on equity. So I just run that. And I'm plotting the histogram here. Notice that it has negative values, larger negative values, and positive values here. It's good to know that we can make the assumption that it could be normally distributed. Obviously, there's some large outliers here. And since what we're going to do now is we're going to turn this into a z-score. In my last video, I was calling them z-values, but they're actually z-scores. You would call them z-scores. I got a little mixed up because I renamed the variable instead of z-score and renamed it z-value because I also wanted to have a z-quality score. In the literature, you can call them z-values, but actually it's easier than not get mixed up and just call them z-scores in general. So I'm going to convert it into a z-score. And remember, the formula for a z-score is for every observed variable or observed output, you're taking that output, that variable, minus the mean of all the observed observations, and that's what I'm doing here, and dividing that by the standard deviation of all the observed values, and that's what I'm doing here. So we find the standard deviation of this population, the sample population, and then we find the mean of it. We take for each value in here, observation in here, we subtract it from the mean, and then we divide it by the standard deviation, and that's how we get our z-score. So we'll run that, and you'll notice the distribution looks exactly the same. There we go. And obviously there's different reasons of why we would create z-scores. It's because in my last video I went into it a bit that we could have statistical hypotheses and make statistical hypotheses of the distribution of the observations, of what percentage is greater than so-and-so, 20%, or less than between 10 and 20%. And we can use z-scores to make those assumptions, because z-scores, or if we make the assumption that they are normally distributed, we can make those probability assumptions. But in this case, what we're doing is just creating z-scores so that we can easily rank them and combine them together and rank them. So let's take a look at profit margin. So profit margin, again, this looks normally distributed. We have a lot of positive values here and negative values. We can convert that to a z-score. We can also look at gross margin. Again, notice what I'm doing here is it's a string and I need to convert it into a decimal. And this is interesting. Why could this be? And I mean, if you think about it, there are not many companies that have negative gross margin. Why would you have negative gross margin? Basically, that would mean that you have revenues. To have negative gross margin, you have revenues minus cost of goods sold. Cost to get those revenues are much larger than the revenues itself, and the sales itself. So that's why you would have a negative gross margin there. So most companies would have a positive gross margin, because why would they conduct business, right? That's not always the case for when you get lower down the balance sheet. Obviously, if you get down to operating margins and net income and profit margins. So let's take a look. Let's rank gross margins. Now we convert it into z-scores. So again, remember, z-score is the larger the value, the larger the gross margin. The smaller the value, the smaller the gross margin. That's all we're doing here. And let's take a look at operating margins. This looks more normally distributed. We're converting it to a z-score. Take a return on assets. Now return on assets gets a little skewed here. That may mean there's just very large or very small return on assets. So return on assets, remember, that is just taking your profit margin multiplied by your asset turnover. So that's your profit margin. Remember, that's your net income divided by your sales and multiplied by your asset turnover, and that's just your sales divided by your assets. So if you multiply those two ratios together, you'll get your return on assets. And also, if you take your return on assets multiplied by your financial leverage, that will get your return on equity. So all of that together, if management can manage each of those variables, you get a higher return on equity. The higher those ratios, the higher your return on equity. The lower those ratios, the lower your return on equity. And our assumption here is that higher return on equity companies and companies that can manage each of these ratios individually, the stronger their balance sheet. That's not entirely true for financial leverage, though. That last ratio there. You may find that large companies that have greater leverage have more risk. So we have to make the assumption. Having debt is not a bad thing on a balance sheet, and that's something that you need to consider. It's how you manage that debt. That's the important question. But we're not going to go too much into that. We're just making a preliminary ranking today. Quality rank. So let's take a return on assets. We're going to rank that into z-score. There, we did that. Let's just take a look at some of the leverage ratios, total debt. So you notice big skew here, that meaning there's a very large ratio here. Let's try to remove, and you also notice a lot of them just have zero debt. So let's just remove companies that don't have any debt at all. And let's shrink this to just only include total debt to equity ratios of less than 1. Just let's see what that distribution looks like. So you notice, most companies just don't have much debt on their balance sheets in general. So you notice I removed companies that don't have any debt on their balance sheets. And then as you move across here, you'll find that there are some companies that do have a higher debt to equity ratio, meaning they have more debt on their balance sheets. So maybe we'll incorporate this. I don't think we'll incorporate it for now. It's just a lot to think about. You can incorporate it later. Again, that's what I'm doing here. I'm looking at long-term debt to equity now. This was just total debt to equity. Again, same idea here. There's more companies that have less debt on their balance sheets. Let's take a look at the current ratio. That's just your current assets divided by your current liabilities. And again, we have this large skew here. Some companies are really skewing this data. It's hard to see what's going on here. So let's just remove companies have current ratios of less than 0. And also just look at companies that have current ratios less than 4 and see what that looks like. Okay, so this is interesting here. So you notice most companies here in this distribution have a relative 1.2 to 1.3 current ratio. Some companies have less, some companies have more. Most have a current ratio of around there. About 175 of them have about that in our distribution. Let's look at the median here. Just curious, 1.8. So about 50% of the companies have less than 1.8 of a current ratio less than 1.8, and 50% of the companies have a current ratio greater than 1.8. That's what we can derive from that idea. Again, given this data set from FinViz. Let's look at quick ratio. Quick ratio is just you're taking your it's very similar to current assets to current liabilities. It's just in your numerator current assets, you subtract out inventories. And so it's more of like and the idea, the intuition behind that is just inventories are harder, they're less liquid, they're harder to sell off. For example, for let's say an automobile company, their cash, they could use that quickly. Their inventory, it might be harder to sell off their cars, their automobiles, in the instance of a crisis or something where they needed liquidity. So, okay, we did that. Let's just look at the distribution here. Notice most companies have a current quick ratio around 1. Now this is the fun part. So what we're going to do is we're just going to take all these z-scores for each of the variables that we took, and we convert it into a z-score, and we're going to find the mean of them. And you can do this in different ways. Basically, we're aggregating them together and we're finding the mean, the average of them. But you could do this in different ways. Maybe you wanted to give greater weight to return on equity, or maybe you wanted to give greater weight to operating margin, for example. Because essentially what we're doing here is we're taking, what do we have here? 1, 2, 3, 4, 5. We're taking 1/5 multiplied by each of these z-scores, right? But you could give a greater, maybe 2/5 to operating margin, right? And the remaining 3/5 to the other variables here. And so that's the idea of what we're doing here. And so we're just going to take the average, so we're multiply 1/5 to each of these, and we're going to get something called a z. Well, I'm going to call it z quality. And it's basically this our aggregate z-score, our average z-score. So let's run that, and let's take a look at the distribution on that. Oh, actually we can rank that. So what I'm doing is just I'm ranking just to see highest z quality score to smallest, and you'll notice we have not a number here. So these were companies where we just didn't have the data, so we couldn't calculate the z-score. That's okay. We could drop those later if we want. Let's just look at the null ones. So these are about 565 out of, I think it was about 7,000 companies. We don't have any values, so is null. That's okay. So that's basically about 500 of these companies are null. Now let's take a look at the distribution. Here we go. So this is a fun little distribution here. So we'll notice that most companies have a z quality score around here. This is exactly what we want. And then we could make statistical, assuming this is normally distributed, we could make some statistical hypotheses and assumptions here of, okay, what's the percentage of companies that are greater than 1 or 2 standard deviations, things of that sort. But we're just ranking here, and let's sort these values. So we can sort them. We can take a look at the companies that have greater than 1 standard deviation, for example, about 183 of them. But remember, we just want to rank, and so that's exactly what we're doing here. We're going to take our z quality, or z score, and we're going to apply a rank function where it's going to essentially put them into percentile ranks. So we can rank them by what's in the 80th percentile and above, what's below the 10% percentile. So, companies that are in the higher percentiles will have higher z-scores, therefore higher quality ranks, or quote-unquote better quality balance sheets. So let's look at the companies that have percentile ranks greater than the 80th percentile. There's about 888 of them. That's funny. Let's look at the 90th percentile, and then what we can do is we can rank them by percent rank. So we'll look at companies that have greater than the 90th percentile, just to filter the data, and then we're going to sort it by percent rank, so the highest. So you notice this first company here. Yeah, let's go to the top here. I'm not familiar with this company. It's an energy company, but it's in the 100th percentile, right? So if we move down here, these are the top quality, quote unquote, balance sheets, give or take, right? And remember, this is a very preliminary quality screen, and you might have to tweak this, and I probably will tweak this. But let's take a look at what's in here. S&P Global, that's funny. Financial data, we're familiar with them. Anything familiar in here? A lot of oil companies, that's interesting. It's basically saying that a lot of these oil companies have very high margins. I have an insurance company here, that's interesting. Some REITs, iHeartMedia, that's interesting. Let's keep scrolling through here. MasterCard, all right. And so you notice MasterCard here, that's a familiar company, has a very high percentile rank here, they're for a high Z quality score. Keep going through here. And so that's the great thing about this. So we have these companies that we can see from an objective point of view. And remember, this data is backward looking. So we have to remember that, finance is a forward-looking exercise. We can use this as a basis of, okay, this is the base rate. This is essentially what happened in the past, last quarter, etc. But we have to still make the assumption of, okay, will that pertain going into the future? But so what we're going to do now is, all I've done is I've taken this Z quality score and I've applied it, overlaid it onto our value screener. So in this Python notebook, I'm just going to run quickly through this. It's very similar to my last two videos. All I'm doing is at the very end, I'm taking the Z score, the Z screen, and I'm applying it on top. And I'm applying the quality score on top. So overlaying it. So this is our final output here. Here we go. So what I've done here is I've looked for the companies with the highest value, percentile value, rank Z value, or Z score for value. And then like my video in our last video, and then what I've sorted the values by the percentile rank for the quality, for this quality score. And so you notice here, these are the cheapest companies that have better balance sheets. So if you notice at the end here, the percentile rank should be greater than the 75th percentile, but the quality rank will be ranked from highest to lowest. And so let's take a look. Do we see anything interesting in here? A lot of oil companies. So these are, obviously these have been greatly sold off, but they may have some better balance sheets out of the rest of the oil companies. We'll have to take a look deeper into that. Credit services. Let's see anything interesting that pops out. iHeartMedia. That's a common one that keeps showing up here. Might want to take a look at that one. What else is here? And remember, the whole idea here is we're looking for cheap companies that have been sold off. Maybe they're not sexy, they're not interesting, they're not glamour stocks, but they have stronger balance sheets, at least with the quality screen that we created. What else do we have in here? Anything interesting? Information provider. We have a grocery store here. Simon Property Group. That's a very large REIT that owns a lot of outlet malls throughout America. What else do we have here? Mortgage investment companies. A lot of mortgage investment companies. That's interesting. Definitely, I've been looking into a lot of those. How they're structured. Maybe I'll do a video into that. It's a very interesting business model. Some shipping companies. Another REIT. This one's an interesting EPR. What they do is they invest in experiential properties. So experiential properties are ski resorts, megaplex theaters, golf. These are their major tenants, for example, golf tenants, things of that sort. So this is I think Topgolf is one of their properties, tenants. And so that's an interesting one as well. So it looks cheap and it could have a stronger balance sheet. That would be interesting. So yeah, so that was the basis of this video. Of course, this gives us a starting base of where we can start looking and investing and maybe taking our time using our analyst skills and seeing where is value, where can we find an opportunity to allocate money where it's been beaten up, it's not heavily followed, and also number two, it has a relatively, at least historically, stronger balance sheet than the rest of the investing universe. So if you like this video, please subscribe. Thanks guys. Till next time. Thank you.